Goldman Sachs just dropped their 10-year global outlook. And folks, this isn't your typical Wall Street forecast. This is a roadmap that puts AI front and center. And they're suggesting some major shifts in where the smart money should be flowing. This is Brian. I'm the founder of Momentous Wealth Advisors, author of the book Momentous Decisions, and I've been a financial advisor for over 25 years. So here's what just happened. Last week, Goldman Sachs released their long-term outlook through 2035. Now, this is different from their usual economic forecast. They're looking at structural forces that will drive markets over the next decade, not just the cyclical ups and downs we see from quarter to quarter. Two mega trends are dominating the vision: artificial intelligence and emerging markets. So let me start with the headline number. Goldman expects global equities to deliver 7.7% annual returns over the next 10 years. Now, before you think that's underwhelming, that's actually right in line with historical medians. The interesting part isn't the number. It's where those returns will come from and who the winners will be. They think the American exceptionalism story may be over, and here's where it gets really interesting for your investment strategy. If you've been heavy in U.S. stocks, and let's be honest, most Americans are, you might want to hear this. Goldman is predicting U.S. equities will return just 6.5% annually over the next decade. That's the lowest of all the major regions they're analyzing. And get this, those returns are expected to come entirely from earnings growth and modest dividends. No help from rising valuations. Compare that to emerging markets, which Goldman expects to surge about 10.9% annually. Asia, excluding Japan, 10.3%. Even Europe is projected to outpace the U.S. at 7.1%. This is a complete reversal from what we've seen over the past decade, where U.S. markets, particularly those in the Magnificent Seven stocks, have dominated global returns. So why is the U.S. losing its edge? The U.S. stocks are expected to lag because of two words: elevated valuations. Right now, U.S. stocks are trading at around 23 times forward earnings. Goldman expects that to moderate down to about 21 times over the next decade. That's a 10% decline. When valuations compress, it acts as a drag on total returns. The S&P 500's net profit margin is sitting near record highs at around 13% compared to 5% back in 1990. Goldman's analysis shows that much of that expansion came from tailwinds that won't repeat: falling interest rates, lower corporate tax rates, and the integration of global supply chains. Going forward, those margins are likely to flatten rather than expand further. That means U.S. companies will need to work harder for each percentage point of growth. So let's talk about the emerging market opportunity. Let's talk about why Goldman is so bullish on emerging markets, because this is where the opportunity lies. Quick pop quiz. How much are emerging markets up year to date? The closest 5 answers in the comments below will get a complimentary portfolio analysis. So Goldman is calling for particularly strong earnings per share growth in China and India. They're banking on higher nominal GDP growth and structural reforms in those particular markets. Historically, when the U.S. dollar weakens, non-U.S. markets tend to outperform, which we've seen this last year. And that adds another layer of opportunity for global diversified portfolios. Now, I know what some of you might be thinking: Brian, emerging markets are risky. They're volatile. I'm not sure I want exposure there. And you're right to be cautious, but here is the thing. Goldman isn't suggesting you go all in on emerging markets, and neither am I. They're suggesting a tilt towards emerging markets, meaning overweighting them relative to a standard global allocation. This isn't about abandoning the U.S. It's about recognizing that the next decade might look different from the last one. Typically, I recommend anywhere from 5 to 8% in emerging markets. But if you're a younger investor, you may want to have 12 to 15% exposure to emerging markets in your portfolio. Now let's get to artificial intelligence, because this is the game changer woven throughout Goldman's entire thesis. There's been this narrative that AI benefits are going to be concentrated in U.S. tech giants, your Microsofts, NVIDIAs, and OpenAIs of the world. But Goldman is challenging that assumption. They believe AI's long-term benefits will be broad-based rather than confined to the U.S. technology. McKinsey estimates AI will eventually be worth $4.4 trillion to the global economy. That's trillion with a T. And here's why that matters for emerging markets. AI could help these economies leapfrog traditional development paths. Think about it for a second. A company in India doesn't need to build out the same physical infrastructure that companies needed 20 years ago. AI and cloud computing allow them to scale globally from day one. Goldman's analysts wrote, "We expect higher nominal GDP growth and structural reforms to favor emerging markets, while AI's long-term benefits should be broad-based rather than confined to just U.S. technology." So let's address just this elephant in the room. Are we in an AI bubble? This is the debate raging right now on Wall Street. AI-related stocks have had an incredible run. Some fund managers see a dangerous disconnect between valuations and fundamentals. Goldman's take: they're comfortable with current equity valuations despite all the noise and chatter. Why? Because earnings are backing up the story. The recent earnings season showed really strong results from AI-exposed companies, and Goldman expects earnings growth to remain the primary engine of performance at roughly 6% annually. They wrote, "A bubble is typically defined by a disconnection between valuations and fundamentals. Their view is that as long as earnings keep growing and companies keep finding real uses for AI, current valuations can be justified. But, and this is important, they do expect valuations to ease modestly from current highs." So the explosive multiple expansion we've seen in AI stocks over the past 2 years, that's probably behind us. Future returns will need to come from actual business performance. So what does this mean for your investment portfolio? All right, let's bring this home with some actionable takeaways for your portfolio. First, consider global diversification. If you're 80 or 90% in US stocks, Goldman's outlook suggests that you'll be leaving some money on the table. Look at increasing your allocation to international and emerging market funds. Second, don't fight the AI trend, but don't pay any price for it. AI is real, it's transformative, but that doesn't mean every AI stock is a good investment at current prices. Focus on companies with clear paths to profitability with AI implementation. And third, emerging markets deserve a fresh look. Yes, they're more volatile. Yes, they come with additional risks. But with expected returns nearly 11% annually versus 6.5% for the US, the risk-reward calculation may be shifting. And fourth, think long-term. This is a 10-year outlook, not a trading strategy. There's going to be years when U.S. stocks outperform. There's going to be corrections in emerging markets. The key is staying disciplined with a diversified allocation. And fifth, consider dollar cost averaging into new positions. If you're going to tilt towards emerging markets or international stocks, you don't need to do it all at once. Spread out your purchases to smooth out volatility. Now, look, Goldman Sachs isn't always right. No one is. But when one of the world's most influential investment banks puts out a 10-year roadmap that fundamentally challenges the U.S.-centric portfolio strategy most of us have, it's worth paying attention to. And this episode is mostly focusing on Goldman's outlook, but this outlook is very similar to Vanguard, to Fidelity, to Charles Schwab. The next decade is shaping up to be defined by AI and emerging markets. The question isn't whether these trends will matter, it's whether your portfolio is positioned to benefit from them. American exceptionalism in markets has been the story for the past 15 years, but every regime eventually ends. Smart investors don't wait for the trend to fully reverse before adjusting. They position themselves ahead of the shift. So take a look at your portfolio. Are you overly concentrated in U.S. stocks? Are you missing out on the global AI opportunity? Are emerging markets represented in a meaningful way? These are the wealth decisions that could define your returns over the next decade. So that's it for today's episode. If you found this episode valuable, please subscribe, leave a comment, and share this with someone who needs it. You can find the show notes and additional resources at my website, momentouswealthadvisors.com. And always remember, the best investment decisions are informed wealth decisions. Once again, this is Brian, the Wealth Decisions Guy. Thanks for listening, and we'll see you next week.